The Federal Reserve keeps cutting interest rates like they did yesterday, but mortgage rates keep going higher and higher and higher, and nobody seems to be able to explain why. This is exactly why it's happening. This dot plot right here. And if you're not sure what the dot plot is, after Fed meetings, they get to update the dot plot. And there are 19 Fed officials. It's 7 members of the Board of Governors of the Fed and 12 regional bank presidents. And what they're doing here is they are saying this is where we think mortgage rates will be at the end of 2025, into 26, et cetera. So this is the big change in this column right here. This is the end of 2025, the expectation. Red is the old votes from the last meeting. Blue is the new votes. So this is what the big change was. People at the last dot plot update were saying, okay, everybody, plan for rates to be 3.25% at the end of, plan for the Fed funds rate to be 3.25% at the end of 2025. Well, after yesterday's meeting, their votes all changed. And you can see they're saying now plan for it to be 4%, not 3.25%. So why do the rates on mortgages go higher when the Fed funds rate drops? Well, the dot plot gets updated, signaling long-term bond yields are going to be higher. So the 10-year Treasury yield spiked in response to this expectation. And so when the Fed signals higher rates for longer, investors demand higher returns for locking in money over a long period of time. And a mortgage is basically a mortgage bond. And so you're locked in for 30 years. So if rates are going to be higher in the near future, but you're going to be expected to tie your money up for 30 years, you're going to demand a better return for locking your money up for that time period. So you can see the opportunity cost of holding long-term bonds increases when short-term rates are expected to stay high. The result, the 10-year Treasury yield rose yesterday. And since mortgage-backed security yields are closely tied to Treasury yields, the increase in Treasury yields directly affected the pricing of MBS. If you're not sure what an MBS is, I tried to chat GPT all this and still not really there, right? So this is the best way to look at it, okay? A home buyer applies for a mortgage lender issues a loan. That loan then gets sold to Fannie Mae or Freddie Mac. Fannie Mae or Freddie Mac buys 100 of them, buys 1,000 of them, and bundles them up into a mortgage-backed security bond. And they sell that bond to investors. And then investors get a share of the interest from those mortgages as a return for the bond they purchased. And so the money that investors give to Fannie Mae then uses to go buy more bonds or to buy more mortgages. And the banks continue to have money to issue new loans to home buyers. So why did interest rates go higher? Let's look at a real world example. A lender issues a $300,000 loan to a borrower at 6.75%. The lender sells this loan to a mortgage-backed security issuer like Fannie Mae. The uniform mortgage-backed security 5.5% bond was priced at 99.35 yesterday. So that means that the lender effectively receives $297,150 for the loan when they sell it. After the Fed's rate cut and the subsequent drop in price to make the long-term investment more attractive in lieu of higher short-term rates, now the lender's only going to receive $295,470 for the same exact loan. And there's a shortfall of $1,680. So does the lender just make less money? Absolutely not. So this is an example after the announcement with the UMBS, Uniform Mortgage-Backed Security 5.5% coupon dropping to 98.49, the lender has to adjust. So they raise the interest rate that they're charging borrowers on the mortgage. And so now they have a $300,000 loan at 7% instead of 6.75%. And that gives you a payment of $1,996, a $50 increase or $600 annually. So that additional money offsets the lower price that the lender is getting when they sell your mortgage. And this is what was happening. This is real-time charts right here. So this is yesterday. You get the dot plot update. And here is the price of this long-term 30-year 5.5% bond the price dropping, 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 dropping. And similarly, the 10-year Treasury yield that's being returned, raising, 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 getting higher, higher, higher. So this is how it's reflected in mortgage rates. You can see here the rates moving up the last couple days. Now, in the big picture, look, we look back over the last 2 years, we're kind of trading in the same range we've been trading in for a long time. There's been some valleys of slightly better opportunity over the last 2 years, but in the grand scheme of things, we're pretty much in a similar position that we were in, just about 6-8 months ago. So just understand, if you're waiting for the Federal Reserve to cut rates, or you hear or you think that next year there's going to be more rate cuts aren't necessarily a good thing for mortgage rates. What drives mortgage rates ultimately is inflation. And until we get actual real inflation coming down, we're unlikely to see mortgage rates coming down meaningfully. And we're probably going to be staying in this range that we've been in for the last 2 years for most of 2025. That would be my guess. If you have any questions about mortgages, real estate, property management, or anything regarding Central Florida real estate, give me a shout. I'm Don Harkins. Thanks for watching.